Welcome to overpriced TV. I'm in London together with Michael Wexler. Michael is the co-founder of Maple Leaf Capital, a volatility hedge fund. Michael, tell us a bit about your personal history. How did you become a volatility trader and what's the history of your company?
Welcome to Maple Leaf, Matthias. Thank you for coming. I've been trading volatility and specializing in vol trading for 20 years, of which 10 years was with banks. I worked for Citibank for about 5 years, Credit Suisse for 5 years, and then set up Maple Leaf with a partner in 2002. So last month was our 10-year anniversary. We have always, over the course of the 10 years as a hedge fund, we've focused on vol as an asset class, specializing in vol. We opened our office here in London, this office in 2002, in Hong Kong in 2006, and opening an office this year in the United States in California, 2012. So we have a global presence now. The business has, over the course of its 10 years, has evolved in terms of how we focus on volatility and the product that we offer to clients, as have the markets evolved and how you have to engage them. Our first product in 2002, for example, was a long equity volatility product, which was a VIX tracker. 2002, there were no VIX futures. They started a couple years later, and VIX had become very popular as something people loved to watch because they knew when equity markets went down, VIX went up, and everybody loved to have something in their portfolio that went up when the market went down, and they had no other way to access it. So we had a long equity volatility product, particularly popular with fund of hedge fund investors who knew that their managers were seeking alpha, but in times of trouble, they all seemed to go down at the same time, and so they wanted something like a short seller that would go up when the markets went down. So that was our first product in 2002, 2003. In 2004 to 2009, the second phase of the business, we had the Maple Leaf Macro Volatility Fund, which was different than the first one in two ways. Number one, not just equity, but equity, commodity, currency, and fixed income, so multi-asset. And number two, not long volatility, but trading volatility. Long, short, relative value, whatever we wanted to do it. And so really from 2004 onward, we've been a multi-asset volatility trading hedge fund. As opposed to prior, we were really a long equity volatility insurance product, VIX tracker type approach. The hedge fund from 2004 to 2009 was very successful. We started with 4 million of our own capital and grew to 1 billion, delivered very strong returns, up 15% a year. So our first 4 years compounding, up 22% in 07 and down 9% in 08. So some difficulties in 08 for an absolute return strategy, but not a disaster. I think for two reasons. One, most importantly, in the context of our own returns, being down 9%, following up 22 and following up 15 a year for 4 years is forgivable. Not great, but forgivable. And also in the context of the markets, people had much bigger problems. Their equities were down 40 and they were losing so many issues in other areas that we weren't the sore spot in the portfolio, so to speak. We changed again in 2010 to be in phase 3, which is what we're in now, largely because we were dealing in a lot of illiquid products in 2009 with banks as counterparties, a lot of OTC transactions. About 80-85% of our portfolio was OTC. And that was fine in 07, not anymore, because the bank as a counterparty, whatever bank you choose, may not be there to pay you in 5 or 10 years if you do a long-dated OTC transaction. Or worse, the collateral that they hold, that you post to them during that time, they may be gone in a year or two and take that collateral to the receiver with them. And so we didn't want to be in OTC products anymore, taking that kind of counterparty credit risk. Basically, the mechanics of OTC, the plumbing, so to speak, is broken, still to this day. And so we shifted in 2010 into phase 3 to have a much more liquid, listed option focused strategy, trading pure volatility. And that's the Maple Leaf Revolver Fund that we seeded in April of 2010, and that is now our flagship product.
So Michael, you've been trading volatility for 20 years. Tell us more about how do you make money in volatility trading? What are the return drivers? How does it work?
The first thing to note about the volatility space is that the bulk of participants in it are not volatility traders. And when I say volatility, let's think of calls and puts. And so people that buy and sell calls and puts determine the price of those calls and puts from supply and demand. 99% of the people buying and selling calls and puts are buying a call or a put or selling a call or a put for a directional view. And those include insurance companies, asset managers, governments, corporates, retail investors, even hedge funds, macro hedge funds, long short hedge funds, etc., buying a call or a put or selling to express a directional view. So 99% of the people trading options aren't trading options, they're buying and selling calls and puts. They're not very sensitive to the volatility component of it. So if a retail investor wants to buy a call on Apple because he loves the company and loves the stock, whether it costs 5% or 6% for that call option, he's still going to buy it. He's really not very price sensitive. From our point of view, whether it costs 5% or 6% is a huge difference, and we can extract that value if the option is overpriced or underpriced. So we call them non-economic volatility traders. People that are making their decisions whether to buy or sell volatility effectively by making a directional decision. And the outcome of their decision, the success or failure of that strategy, is again a function of the directional outcome of the asset. So if you buy a call on Apple and the stock went down, you lost your premium. Whether the stock went down slowly, quickly, gyrated, fast, how volatile it was on the way down, none of that matters. You bought a call, it didn't happen. So it's not even self-defeating or whether your directional strategy is a success or failure based on your directional outcome. And so they remain and continue to be reinforced as non-economic volatility traders. Now, the second thing is that second driver, I guess, that makes it a very non-crowded space to be in because there's only 1% of people in the volatility space trying to offer liquidity, let's say, or capture the dislocations created by the 99%. The second thing is that, generally speaking, over time, options are overpriced. That's a generalization. It's been true for hundreds of years, so it's not something post-08 or Lehman related or whatever. It's been true for hundreds of years. It's because actually, when you think about options, if you think about it like insurance, you can understand it very easily. What is insurance? An insurance is a put, right? When you buy insurance, you're buying a put on your life or your car or your house or whatever it is. It's just a put option. You pay a premium, and if it happens, the insurance company pays out. The only difference to financial markets is there are calls and puts, but you pay a premium up front. And based on the insurance company, the premium that they charge for that put option, that insurance, is a function of how probable is the event. Same thing in financial markets, but it's based on people's perception of the probability of that event. If they think it's going to happen or not, and they buy those puts and calls. So those prices fluctuate. Now, in the case of insurance, it's easy to notice that it's always overpriced. It doesn't mean the outcomes never happen, but it means the insurance company makes a profit and survives for hundreds of years and does very well because they know the probability that you're going to burn down your house next week, and the premium that they charge you for that insurance is slightly higher than that probability, and they make a profit at it. And they're great businesses. And so why do people overpay for insurance? Right? In fact, most, if not all people, realize the insurance company is making a profit on you. You may crash your car and they don't specifically make a profit on you, but you're overpaying them for the outcome that you're buying. Why do you knowingly make a non-economic decision to purchase something that's overvalued? Usually before you buy something, you say, is this fair value or not? Here you say, I know it's not fair value, I know it's overpriced, and I'm going to buy it anyway. And so you do that really for peace of mind, to sleep better at night. And that's really the reason. That's human nature. You sleep better at night because if you look out the window in the morning and your car was stolen from the driveway, one phone call, another car there tomorrow, it's somebody else's problem. That's very comforting, right? And even people who can afford to self-insure, who can afford to say, if my car is stolen, I can afford to buy a new one, and so why should I pay this above odds probability premium for the put option on the car? They do it anyway. right? And that's, people worth hundreds of millions of dollars have a $2 million life insurance policy. They just sleep better at night because of it. That translates through back to financial markets. The same humans are participating, where people love to buy crash protection. They love to own calls for leverage to the upside. A company that's producing nickel loves the idea of paying a fixed amount of premium today that they know they can afford in exchange for protection to the downside, unlimited upside. I mean, how could you not like that description? Unlimited upside, limited downside, and protection you can afford. I mean, everybody's going to sign up for that. And so you overpay for that. You overpay for that privilege. So that creates an environment where, generally speaking, well, in insurance, it's always overpriced, I can assure you. In financial markets, it's generally overpriced, where options are too expensive. And that is a source of structural alpha, of money to be harvested, of a source of risk premium to be harvested from participating in the vol space. So that's a big driver of returns.
Tell me about the different funds and the different strategies that they deploy in the volatility space and how you differ, how you are unique in that space.
The vol space is a bit of a misunderstood space sometimes, because when people draw their pie chart of hedge fund strategies and they have long short and they have fixed income relative value and event driven and stuff, and they draw this bucket, a little slice sometimes called, okay, vol, let's put all these vol funds in there. Well, the problem with that is saying vol fund is kind of like saying equity fund, right? Well, there's a lot of different types. There's long short. In equity, you could be long short, you could be long, you could be short, you could do stat arb on equities, you could do things on a fundamental basis, on a quantitative basis, on a macro basis. There's all kinds of ways to trade equity, and you could be a momentum fund, a growth fund. I mean, there's 100 ways to slice it. Vol is kind of the same, yet there are only a few vol funds, so they all get lumped into, oh, you're in the vol fund space. So there are vol funds that are always long, tail risk funds, crash protection funds, that kind of stuff. There are vol funds that are always short, that are just short vol and that kind of thing. There are vol funds then who are going to be single asset or multi-asset, quantitative or fundamental. So you need to do a little bit of researching within the vol space as to, okay, what type of vol fund is this exactly? Vol just tells me they trade options, but it doesn't really tell me what they do in that space. The vol space doesn't have a great history, because any fund that is only long vol bleeds to death at some point in time. Right? First of all, they're probably overpaying for that vol, because as I said, options are generally overpriced. So the wind is in their face. So you really have to time it right. And even if you time it right and you started your vol fund on January 1st, 08 or something like that, great, you'll have a wonderful year. Or if you started in 2001, 2001, 2002, you might have had great years or something, and then you bleed to death. And then comes 03, 4, 5, 6, 7, and you probably don't survive that long, losing 10, 15, 20% a year or something. Your investors eventually leave you and you go out of business. Similarly, most funds that have tried to be dedicated short vol funds have not done it in a professional way. And so they come out and they say, okay, we're a short vol fund, we sell vol on the S&P. Strategically, we do this and that, and we're very smart about it. We sell vol on the S&P. It makes sense because there's a risk premium embedded, and you should make money selling vol on the S&P because it's overpriced. But they're only selling vol on one thing. And one day the S&P has a big move, once every 5 years or 10 years or whatever it is, and they blow up, and they lose a ton of money, and they go out of business. And so even if their strategy makes money over the long run, so they make 1% a month for 5 years, and they're up 60%, just thinking about it simply, and then they drop 30 in a month, right? Maybe over the long run the numbers still make sense or something, but investors just don't want to have that single large drawdown. It's not a good Sharpe ratio, and it's not what human beings like. They like to sleep well at night, not to be woken up to find out, this short vol strategy lost 30% one day. So I think that the way short vol has been implemented has been immature. The way long vol funds have been implemented have generally bled over the period. So there aren't a lot of vol funds that have been around for 10 years or an extended period of time in that way. The way we fit into that space and are differentiated somewhat, and we've been around for 10 years now, We have shifted our business over time, as has been required by the markets, as I said. And we do a couple things. Number one, we are multi-asset, equity, commodity, currency, fixed income. That's really important, particularly because if I had to choose and be only one of those asset classes, the one that you definitely would not want to choose is equity. Yet that's what most vol funds that you see are equity vol funds. You wouldn't choose equity because it's the hardest asset class in which to get diversification, right? All equity indices globally look like one index in a crash. You could trade a US vol fund that trades vol on 100, 200, 500 US single stocks. Look at our diversification. Yeah, well, all those stocks behave like one stock when there's a crash. So if you're a dedicated short vol fund on 500 US names, that really isn't very diversified at all. The key to success in selling vol, and when we talked about the insurance companies, how come they survive for hundreds of years and not just one cycle, is that, well, obviously they sell insurance above its fair value, but number two, they diversify their portfolio. So they insure you and a million other people so that when you do crash your car, yes, they pay out, yes, they lost money on you, but that's okay. That's not a bad outcome from the insurance. That's part of being an insurance company. A million other people didn't crash their car today, and that's, and they've collected premium from everyone, so it makes for a good business model. So by being multi-asset, we are able to much better diversify our exposure, our short vol positions when we take them across multiple asset classes. And geographically. So we have diversification across 4 asset classes. When we trade vol in our revolver fund, we only do it on equity indices. It's S&P, NASDAQ, Russell, Nikkei, Hang Seng, Kospi, DAX, FTSE, Eurostoxx, etc. So we have global diversification as well, maturity diversification, all kinds of stuff. So to be a successful insurance company, you wouldn't have an insurance company that sells puts on one boat or one building or one life. Because eventually the boat sinks or the building burns down or the person dies, and you could have some great years until that happens, but then it's game over. So I think being multi-asset is extremely important. Plus, some asset classes are more interesting than others at times, right? Equities had a particularly boring 05, 06, part of 07. Commodities didn't. Commodity bull market took off in 05, became fantastically interesting. So the ability to shift your focus or your capital allocation and resources to 4 different asset classes makes for the ability to endure over time and continue to find opportunities. We do have a short vol bias, although we're not a dedicated short only fund or a dedicated only. We have a short vol bias because I think you have to have the tail at your back over the cycle, the wind at your back over the cycles. If you had a long vol fund, you really better time it well and then say to investors, okay, the crash happened, let's close it this year, But people don't do that, obviously. So we do have a short vol bias, very diversified portfolio, hyper-diversified portfolio on the short side, and then we have a long vol hedge. And the long vol hedge tends to be much more concentrated and aggressive, because when you're buying vol, you don't need to be very diversified because there's no left tail. You're paying premium, and if you bet on one building and it doesn't burn down, you waste some premium, start again next month or whatever it is. And our portfolio, we also tend to, or we do, stay very short dated, very liquid. As I mentioned earlier, we're not big fans of OTC credit risk with banks as counterparties. We like to have our options listed on exchange, front month contract, that kind of thing. And so the portfolio can change very quickly. If you're just trading front month options and stuff, you can shift the portfolio within days or weeks. Everything matures and you're on your way again. And so when there is a shock event or something like that, the portfolio can adapt very quickly.
Right now, since April 2010, you run your revolver fund. You started the fund in April 2010. Until December, you were up 25%. In 2011, you were up 15%. And now in 2012, you're up 3% by mid-year, right? So this is a fantastic track record, beating a lot of hedge funds and other volatility funds out there. Tell me, Michael, what assets do you trade in the revolver funds and how do you do it?
The revolver fund we're very focused in terms of what we do. We only trade vol on the biggest 50 assets globally. When we say biggest, maybe isn't the right word, the top best known 50 assets globally. So within equities, that's only indices. as I mentioned, the big name indices. Within commodities, oil, natural gas, gold, silver, copper, aluminum, nickel, etc. Within fixed income, no corporate credit, just government, the benchmarks. So bunds, JGBs, gilts, treasuries, Eurodollar futures, Euribor futures. And finally, within currencies, euro, yen, pounds, dollars, Swiss francs, Canada, Aussie, etc. So the biggest 10 to 15 assets in each of the 4 major asset categories of the world create the top 50 most liquid super assets, mega assets, and that's what we trade. That's what we trade vol on. And when I say trade vol, what does that mean? That means a 1-month straddle. That's it. A call and a put, struck at the money at the current price. We either buy it or sell it. So we basically have a long-short portfolio. Instead of being long-short equity, it's long-short vol. That means long-short, 1-month straddles on all those things. They are always 1 month. We don't trade shorter, we don't trade longer, we trade 1-month straddles. Pure, simple, clean. It's not out of the money, it's not calendar trades, it's not relative value. We buy or sell 1-month straddles on the biggest 50 assets globally. The strategy is purely quantitative. We used to have a macro overlay in our last fund from that quantitative output. In the revolver fund, we've stripped that out, and we religiously implement the quantitative output from the model. I should qualify what does that mean to say, a quantitative strategy, because we're different in that it's nothing like what CTAs and stat arb funds mean when they say quantitative. CTAs are looking at crossing moving averages, trend and mean reversion, and stat arb, and looking at data patterns in the air, mining billions of tick data points for patterns and things like that. That's not what we do in terms of quantitative. Quantitative, the way we describe it, the way we have done it, is effectively rules-based trading where the rules came from our brains onto paper. So we used to make trading decisions, this is going back 15 years, by, I feel like buying some vol on the NASDAQ today, or I feel like selling some vol on the yen, or whatever it is. Why? I don't know. I just feel, right? So it comes from your head, and it's experience, intuition, wisdom, knowledge, hunch, whatever you want to call it. Your brain obviously is going through some kind of decision tree based on the factors that you're seeing in the world and the marketplace, all the inputs that come into you, processing that decision tree and coming up with an outcome. And we said, why don't we try to put that outcome down on paper, that decision tree, right? If we can put that on paper, that gives us 2 advantages. Number one, we can implement those decisions in a non-emotional way, because emotion is the enemy of trading, right? When you're emotional, you make non-economic decisions because you're stressed, it's the middle of the night, you're worried about your paycheck, your wealth, all kinds of things enter into create stress that make for bad trading decisions. And that's inevitable in humans. As a trader at the banks for 10 years, one of the key success factors in trading, one of the key tasks, is to disassociate emotion from trading. I'm making money today, I'm losing money today. It's, there's no smile or frown either way. It's just a fact. And that makes you a stronger trader. But it's impossible to do it 100%. And in fact, for most people, it's impossible to do it at all. And so if you have a rules-based system that you say, this is when I would decide to buy, this is when I would decide to sell, etc., and that's on paper, and now a computer implements those rules that I have, my ideas, my brain, now the computer doesn't flinch when there's an emotional situation. It also trades 24 hours, reacts very quickly, efficiently, can size the portfolio properly. It's all rigorous. Risk management, everything can be built into that. The other thing, and I think just as important in terms of why put your brain on paper, is because then you can backtest it. Then you can actually be honest with yourself and say, do I come up with good ideas? Right? If you ask someone, do you come up with good ideas? Of course I come up with good ideas. What are you going to say? I think I'm smart, But in fact, do you know every time you input these set of data and get that output, does it actually lead to a profitable trade or not? Right? And so if you can actually put the decision tree down and you have an enormous database from which to work with historically, you can come up with, do my ideas make money or not? Maybe some do, some don't, some, I should weight them differently, use them at different times, things like that. And so to give you an idea, as an example, now is great. It's June. The sun has come out. Summer is coming. I read multiple research papers, trade recommendations from banks that say, sell vol. Summer is here. Why? Because people go on holiday, volumes decrease, markets get quiet. Great to sell volatility in the summer. Pick up some premium. Good strategy. Well, that may be intuitively sensible. Might seem like, yeah, summer does get quiet. People do go on holiday. Hard to disagree with that, But does it actually make money or not? Maybe the market already factors that in. So we go back to our database and say, all right, well, I can test that. I can say, what if I always sold volatility in June and bought it back in September? Every year for the last 20 or 30 years, across thousands of assets globally, does that actually make money or not? Right? And then I can see, well, it turns out it made money in the 90s, but it doesn't make money anymore. Or it makes money in Asia, but not in Europe. Or it makes money in fixed income, but not in currencies. Or yes, it makes money, but it's a terrible Sharpe ratio. Or you can come up with a statistically significant, objective, data-driven result of, is that actually a good idea or not? As opposed to trading from your head and saying, yeah, summer's coming, it's June, let's sell some vol. The database that we use as a tool to drive that research is an enormous resource for us. We started building it in 2002. It's 6,000 assets, even though we only trade vol on 50 assets, as I mentioned. It's 6,000 assets globally, 4,500 single stocks, commodities, currencies, interest rate pairs, everything, going back 10, 20, 30 years sometimes. And when I say it's implied volatility, realized volatility, everybody has the data. Implied means what were options trading at, what were insurance premiums on every day going back 10 or 20, 30 or 30 years. And had I decided to sell volatility on oil in June 1993, how would I have done the next month had I sold at that premium and realized the following volatility? So we can backtest strategies. We still maintain that database, obviously. It's 30 million data points a day to capture, store. Obviously, it's not done manually. It's a programming task. We have 3 programmers on that effort. And it's enormously intensive. And it's very hard to backpopulate. In 2002, when we said, let's set up this database, where do you get Swedish interest rate vol from data from the 1990s? Right? There's no exchange that gives it to you. There's no, here, look it up on Bloomberg and download it. Nobody, it comes from traders that were trading at that time that have 5.25-inch floppy drives. When I was trading currencies in 1993, each day I saved down my vol surface on a disk. A 5.25-inch floppy drive, and I have stacks and stacks of them at home. There's lots of other traders with a few gray hairs that have tons of that stuff. You need to go and collect it all and say, how do I really put together a good database? Some you can buy now in equities. You can buy a decent amount of it. Some you can get from brokers. Some you can get from interdealer brokers, from banks who used to get faxes every day. They have thick folders in their archives for 10 or 20 years of that stuff. So it's very hard to build that database. It's multi-asset. I think I don't know as a fact, but it's probably the best implied volatility database globally. Just because there aren't that many people building vol databases, and there are very few that are doing it on a multi-asset basis. Very few, if none, that started doing it 10 years ago, and it's quite a big task to do so.
Tell me about how you manage risk, and how do you do it geographically? Do you have a certain risk officer that's sitting somewhere overlooking your different offices? Tell me more about that.
The risk officer is sitting in front of you. I am the risk officer. My partner, George, with whom I founded the firm, oversees the research group, the quantitative analyst team, and the implementation of the trading strategy. So he's effectively the portfolio manager. And the key parameters of risk, in terms of what it means to manage risk, is very simple. I mentioned, what does an insurance company do well? Managing risk on the short vol side is what's important. On the long vol side, it's not going to blow you up. And assuming it's not sized ridiculously, it'll bleed when it does poorly, slowly, and that's okay. On the short vol side, it's the real question for us of risk management is, how do you manage short vol? How do you manage a portfolio of diversified insurance bets? Number one, we never have more than 5% of our short vol risk budget on any one asset. So that means a minimum of 20 bets. If we had only 15 bets, by definition, one of them has to be more than 5% of the total portfolio. So we force our models to choose more than 20 assets on which to sell volatility. So that gives us diversification across assets. Plus, since we only have a universe of 50 assets globally, and we must have more than 20 shorts, we have a pretty diversified short vol portfolio. The second thing is, and this is what I alluded to earlier about equities being, if you were going to focus on one asset class, you wouldn't want it to be equities as one only, because equities, it's the hardest asset class within which to achieve diversification. So the second rule really is driven by that, which is no more than 30% of our risk budget in any one asset class out of the four. So it forces, almost 25 across each of the four. At an extreme, we could be 30, 30, 30, 10. But really having no more than 30 in one asset class is in order to prevent a situation where you might have short 5% of the risk budget on each of 20 equity indices. That's going to look like one trade when things get ugly. So we force ourselves to have four asset classes, diversified across multiple assets. So we get asset class diversification, asset diversification. It forces geographic diversification automatically, and makes sure that the short vol portfolio is contained. The other thing is that it is position sizing and how you let your overall risk float. One of the problems in financial markets that is less of a problem in insurance is that in insurance they are very able to diversify their risks, because there isn't going to be an earthquake on 6 continents at one time, on one day. 1 million people aren't going to crash their car the same day. So they're really able to diversify properly. In our case, we recognize all of our short vol positions are still financial instruments, financial market instruments. And so there can be a financial market hurricane all at once, or a financial market earthquake that shakes all of our short vol positions at once, a Lehman Brothers type event. That's really a good example. That was, once in 80 years or whatever, the worst in 80 years at that point in time. Could be another one, sure. But that was a good example in our carve out of our, when we show our returns and we show prior to April 2010, we did this strategy. We've been implementing this quantitative approach, except we used to overlay a macro view and pick and choose and do more complicated instruments and stuff like that. But we can show exactly what we would have lost in the Lehman period from this strategy, etc., and help us to size our positions appropriately so that when there is a financial market hurricane across all things, there will be a loss on the short vol portfolio. The long vol position will help. Long vol hedge will help. But if you're net short, you expect to net lose money when there's a shock event. But if you size your positions appropriately, the loss is commensurate with target returns and what you can make back and how quickly, and it's acceptable. No strategy is foolproof, so there are going to be losses. So you say, when we lose money, how much are we prepared to lose? Why is it going to happen? Let's, in advance, discuss risk management in advance, because when the milk falls off the table is not the time to think about risk management. The milk is spilled, there's nothing to do about it. The time is when it's on the table to say how much milk can we have in the glass, because it may be knocked over and probably will be knocked over at some point. So let's think about that in advance. So all those things are programmed into our model, which is telling us which vol is cheap, which vol is expensive, what things to go short, what things to go long, and how much of each we can do in order to fit within those risk management constraints.
Tell me more about the setup of your company, Maple Leaf, where you're registered, how many people do you have, etc.
In terms of regulatory-wise, we're regulated in Hong Kong and in London by the SFC and the FSA. London is the operations and quantitative analyst hub, and Hong Kong is the trading hub. George, my partner, is back and forth between London and Hong Kong. I'm back and forth between London, Hong Kong, and Los Angeles, where I'm actually based, to open a US office. And so it's spread that way. We all use Skype video, logged on all the time. I work unusual hours on the West Coast. He works unusual hours in Hong Kong because there's people in London. We have 13 people divided across the different tasks. And as I said, I'm in terms of investor relations, business development, running the company, overseeing the risk on the portfolio. George focuses on portfolio management, making sure the systems are implementing correctly, both of us spent a lot of work on how to continue to improve the model in order to obviously continue to develop as the world changes and we learn and become hopefully smarter over time, and give tasks and keep the programmers and the quantitative team on track from a project management standpoint for deliverables and how we think that can improve our performance. We're always coming up with new ideas for how to trade vol. Somebody might suggest, maybe you should buy vol when GDP growth falls below 2%, because that usually means a recession is coming. Like, that seems intuitively interesting. Sure, let's backtest it. Let's go and have all the GDP, let's go and say, if we always buy vol in a country when GDP growth goes below 2% year over year or whatever, how would that strategy work out over the last 10, 20, 30 years across multiple countries all over the world, etc.? Let's look at the output. We come up with hundreds of ideas a year like that in terms of what would make sense for buying or selling volatility. Almost all of them turn out to be useless. Almost all of them turn out not to work. And so that's why we don't trust our brains just to call it intuition, wisdom, experience, intelligence, whatever, to say, yeah, that makes sense. Okay, I'll buy. It doesn't work. The market sees those things. The market prices in those things sometimes. Once in a while, we find right now we have about 16 different tests or rules in our model that work, that are back tested, and they're integrated and optimized and all that stuff. Each year now we're coming up with about one new one, and each year we're kicking out about one old one that doesn't apply anymore. So the model's not shifting very quickly. It's a slow-moving boat. We've plateaued at 16 now for 4 or 5 years. We don't seem to be able to increase, although it's not decreasing. But each year, for all of our research and development work and driving new ideas and trying to understand the world better in terms of what drives volatility, we come up with one new idea that genuinely, when you're honest with yourself and humble and take ego out of it, you backtest it and find, yeah, that actually works. And so the model is slow moving, and George oversees the continuous development of that model, and obviously all the tools for 24-hour implementation, delta hedging, that kind of stuff.
Michael, you and George, you're running Maple Leaf Capital for 10 years now. Over this time, what has been your experience about your understanding investors have in your asset class? And do you see more investors now being interested in this, let's call it uncorrelated asset class?
The interest in the volatility space tends to correlate a little bit with volatility in the markets. When markets get volatile, more inquiries come as to, oh, you trade volatility, must be something to do here. Now's a good time for that, in that we're not in 08 or 09 anymore, but the base level of volatility is probably at a higher sustained level now than it was prior to 08. So the VIX as a benchmark, even though it's only one asset, one index globally, used to go down to 8 or 10, and now it seems like 15 or 17 is kind of the bottom level, and then trouble comes again. So we're probably in a higher base environment for volatility than we were five or more years ago. And fundamentally, it would seem that's probably going to remain. The sovereign problems aren't getting solved any day soon. Banking problems are here for years to come. Deleveraging is going to take years. The effect of trade globally and cross-currency flows effectively have probably raised the bar on volatility to come in the capitalist or in the world as a whole. The investor interest is high also because when things get volatile, people do poorly generally on their investments. Volatility is the enemy of most investment strategies, right? Higher volatility means lower markets, means guys are getting chopped up on their strategies, on their stop losses, and getting in and getting out, and friction. And most strategies do better in a rising market than a falling market. I mean, that's the little hidden secret, but equity long short is really big long, little short. And even strategies that are meant to be really neutral, risk arb and stat arb and stuff like that, they're all implicitly short volatility. Now we're explicitly short volatility, at least we say, hey, we're going to do it. Nobody asks a private equity guy, are you short volatility? But really they are. When the market goes down and volatility goes up, they lose money like everybody else. So the fact that investors are getting frustrated by volatility being their enemy, and by volatility, oh no, can't sleep well at night managing a portfolio of money with volatility, they come and say, well, how can I profit from volatility? We make more money in a high vol environment than a low vol environment because the dislocation between the fair price of insurance and what it's trading at, or the fair price of options and what it's trading at, is bigger at higher vol levels than at low vol levels. When the VIX is 8 or 10, maybe it's worth 10 or 8 or 12. When the VIX is at 30, maybe it's worth 40 or 20. So the sources of dislocation tend to become bigger when you're in a more high vol environment. As you said as well, the uncorrelated asset class, more and more people realize that they need greater diversification in their portfolio. The old model, 60 equity, 40 bonds, had one good thing and one bad thing about it, and now the good thing is gone. When the equities went down, the bonds went up, right? Okay, it made some sense. Well, now bond yields are so low that bonds can't go up much more. If yields aren't going to go below zero, there's very little left. So next time equities go down, your bond portfolio is not going to contribute the kind of returns that you used to get from it at all, as a fact, right? Especially if you have 5-year stuff, with yields close to zero, or 2-year yielding zero, your 2-year bonds aren't going to jump next time the equities drop. So that's driven a search for higher returns in general because the yields are so low, and better diversification. And the equity, the 60 equity, well, we have equities all over the world, in this country, and that, and these single sectors and whatever. Yeah, but they're all equities. All your equities become one thing called 0.6 equity when the market goes down. So you really have now generally a very poorly diversified portfolio with this one equity thing, these bonds that yield very little and certainly aren't going to make your income or target return desires. And so people are looking for higher returns. They're looking to see how can we make money, who makes money from volatility in a volatile market, and returns that are uncorrelated. Historically, the strategy has made money in both rising and falling markets. It makes more in rising markets than it makes in falling markets, but still makes in falling markets. So it manages to be negatively correlated in down markets, positively correlated in up markets, which is kind of the holy grail of what you dream about, but certainly can profit from a crisis period like post-Lehman for almost 2 years before the VIX went back below 20, before people started to calm down a bit, was a phenomenal period. Same thing in 2002, post-NASDAQ, right? There was the strategy had an excellent return because there's a shock event, dislocation, crisis period, recession, whatever it is, and we're able to profit from that. So there's lots of interest, still lots of education required. Still, people, what does that mean to buy volatility? I understand I buy a table, I hold it, I know what I own. I buy a stock, I know what I own, it's paper, it's a financial asset, but I kind of get it. But I think they're almost at the stage where I buy insurance, I know what I own, so I buy a put, I know what I own, a put and a call, you trade them, okay, they kind of get trading volatility. So, education over the generations is happening, but we still have lots of education to do with our investors.
Michael, who is now particularly interested in your strategy?
Our investor base is changing. We are targeting now a lot more high net worth and smaller family office. It's a group that we never targeted before. Prior to 2009, we couldn't have an intelligent conversation with a high net worth individual because we were trading correlation swaps and variance and all kinds of the funkiest complex instruments, stuff that we had designed at the banks, stuff that the French banks are selling clients named after mountain ranges in structured products and things like that. We built and designed a lot of those products, and so we understood them and we took on those risks. But it's hard to sit down with a high net worth guy who made his money in the steel industry or manufacturing clothing or whatever it is and say, use words like gamma or vega or convexity or whatever. They just aren't going to get it and aren't going to feel comfortable that you know what you're doing. Post 2009, when we said, okay, no more OTC, no more illiquid instruments, no more funky stuff and credit risk, let's stick with pure 1 month straddles, which can really be talked about like buying and selling insurance. It's much easier to get the idea across. It's not as easy as equity long short to describe. It's vol long short. Long short, you understood, okay, well this is long short vol and here's how we do vol, kind of makes sense, premiums, too high, too low, that kind of thing. So because the strategy is much simpler than it used to be, And we have 14-day liquidity now. So 2 weeks notice and you can redeem, and investors love that. Our old stuff, we had a much longer notice period because we were dealing in much less liquid stuff. But with 14 days notice now, investors sort of, okay, you're in liquid stuff, we can get your money out when we need it. That again is much more palatable to the high net worth individual or smaller family office. And so we're building, we've never talked to them before, but we are building and expanding, generally, we are building and expanding our inroads with that area via private banks, via, learning the distribution networks with how you get to that group in order to sort of round out our investor base.